Hey, welcome back to YT Finance, and today we are talking about Palantir Technologies PLTR stock, Sofi Technologies SOFI stock, and Lending Club's LC stock. We will start by discussing the newest PLTR stock price predictions and stock price targets by analysts. Then we will talk about their CEO Alex Karp and other insiders that are selling Palantir stock. Then lastly, we will discuss Palantir's plans for their stock-based compensation. After that, we will talk about why Sofi Technologies is a great buying opportunity right now. Then we will talk about why Sofi Technologies is a great buying opportunity right now, followed by Lending Club, which is another great fintech company with a huge addressable market and great growth prospects, which will also diversify your portfolio. Go and press the like button right now for more Palantir stock, Sofi stock, or Lending Club news and analysis. Comment your own price predictions for next year regarding PLTR stock or Sofi stock. Turn on all subscription notifications to stay informed, and now let's get right into today's stories. Currently, the big data and analytics company named Palantir Technologies, ticker symbol PLTR, has an overall hold rating by analysts, to where 4 analysts say to sell the stock, 4 say to hold it, and another 2 say to buy it. Right now, Palantir has an average 1-year price target of $24 per share, with the low-end price target being $18, a high-end price prediction of $31, and a fair value price of $31 with a current price of around $19. So Palantir stock still clearly has a lot of upside to gain over the next year. Recently, on November 19th, Zacks Investment Research lowered their PLTR stock rating from a buy down to a hold rating, and the Royal Bank of Canada cut their price target from $25 down to only $19 per share. But before that, in August, a Jefferies analyst upgraded Palantir from $28 to $30 per share. But overall, analysts do seem to take more of a negative and bearish approach to this company. More bad news comes in the form of the CEO, who is Alex Karp, who sold almost 190,000 PLTR shares for a quick $3.9 million payday, and another insider before that named Ryan Taylor, who also sold some shares numbering over 61,000 for a payoff of $1.2 million. The last of the bad news comes in for the PLTR stock price, which is taking a great beating after their amazing Q3 earnings report. As you can see on screen, the graph shows that Palantir has lost around 22% of its original value. But despite all of that, I personally am still very bullish on the stock because of the fundamentals of the company, and those are still very strong. Even though the previous news was all bad, it really doesn't impact their fundamentals or how the company operates literally at all. Now, bearish negative investors could say that the stock has been trading sideways for a year just to fall, and that their government software has slowed its growth on top of stock-based compensation, which is really bad for investors, plus a gap loss. But to that I say, let's look at the data to extinguish all of this FUD. First, let's address the stock-based compensation, which their CEO just doubled down on, because he says that we have hired the best and most interesting and eclectic people in the world. They are very fairly compensated, and we will continue to develop these products and continue to compensate people. From the sound of it, Palantir does not plan on taking away their stock-based compensation plans anytime soon, but this is actually an advantage for long-term Palantir investors, so let me explain why. First off, stock-based compensation allows Palantir to pay their engineers a lot more than what their competitors can afford to pay their employees, so this will cause the best talent in the world to be attracted to Palantir. This in turn will allow Palantir to make the best software in the world, which will make them irreplaceable to both their government and commercial clients. Speaking of their government clients, Palantir has inseparable ties with the United States government, and as America's threats continue to innovate their own software technologies, the government will need Palantir's expertise to fight back. This means that Palantir is poised to profit from the government's growing demand, which is no surprise because Palantir already has a strong foothold in government contracting. The CEO is very America-focused because he says that the core mission of our company always was to make the West, especially America, the strongest in the world for the sake of global peace and prosperity. end quote. Sadly, Palantir's international government business with European nations and the United Kingdom have not taken off as much as some investors would like, but this leaves a huge growth runway for Palantir to take advantage of in the future. Another cool thing about Palantir is that they refuse to work with any US rival, unlike other technology companies like Google, which makes Palantir more trustworthy in the eyes of the government. Basically, if other companies like Google continue to work for the enemy, how can we trust them with our data? Palantir's CEO believes that the country with the greatest AI technology will determine how the majority of the world lives their lives. But this comes with a warning, because if the wrong company or country for that matter gets this AI technology, this could have dire consequences. This is why Palantir continues to try to attract the best engineers by any means necessary, including stock-based compensation, to ensure that this does not happen. Apart from Palantir's government connections, I am more fixated on their commercial clients because their potential commercial customer base is not only larger than their government segment, but I think it will allow them to become a profitable company. I arrive at this hypothesis by simply looking at how they are scaling their commercial revenues year over year and quarter over quarter, which you saw on the previous slide. In quarter 3, PLTR increased their US commercial revenue by 103% year over year, and with their overall revenues growing at a rate greater than a 30% CAGR, their commercial revenues will not only pick up the potential slack from their government contracts, but it will also eventually exceed their government revenue altogether. Now I want to focus on Palantir's total addressable market, which is approximately $120 billion, with a compounding annual growth rate of 22.4% until 2030, which equates to an amazing market opportunity. Palantir also has impressive partnerships with companies like IBM, Amazon, and many others. We also have to account for their steady stream of revenues from their government contracts, on top of them having virtually no debts, over $2 billion in the bank, and active investments in up-and-coming technology companies, so Palantir is more than set to have a massive growth in the near future. Next, I want to talk about Sofi technology stock, ticker symbol SOFI, which is a fintech company that provides a one-stop shop for anything relating to finance and loans. Recently, Sofi had a great earnings report, but the stock still dropped substantially in price. While Sofi did rally around 80% in the last few months, the stock has since corrected. To me, this stock is a clear buy at around a $15 price range or cheaper, especially if you plan to hold it long term. But why is Sofi stock pulling back right now, and why is it falling in price? Well, it's falling for two main reasons. The first reason is due to insider selling, where the company's management team are selling their shares, and the second is that the overall fintech space seems to be pulling back right now. The current downtrend could lead to the stock price dropping between $16 and $14 per share, which is a great buying opportunity because once investors start to buy the stock at those prices again, and the stock reaches at around a price of $18.69, the stock should pop up again, especially if we get more news on their major bank charter catalyst. This is where I want to introduce you to another stock that I think should be added to a watch list, and that is Lending Club, ticker symbol LC. Lending Club is one of the original fintech companies that offered very low loan rates to customers, which were much better than what traditional banks could offer. But in 2016, their CEO had a scandal, and their stock price has suffered ever since. However, recently the stock popped a whopping 350%, so that means we should pay attention. Lending Club has originated around $68 billion worth of loans for more than 3.8 million customers over its lifetime. The reason why they are so successful is that they use data algorithms and AI technology to look at 150 cells of data to offer customers very low rates while preventing any defaults. Their 30-day delinquency rate is half of its competitors and 35% lower than its overall industry rate, which makes this company extremely innovative. This company also automates their loan processes, so they save loads of money on overhead as well as employee compensation compared to other companies. Just in the third quarter, Lending Club originated $3.1 billion worth of loans. They had $246.2 million worth of revenue and $27.2 million worth of net profits. This equates to a 247% revenue growth rate from the prior year, and this number is set to increase even more due to their auto loans. Also, unlike SoFi Technologies, LendingClub is a bank which gives it a competitive edge over its competition. Despite its past, the company looks good enough to at least add it to a watch list, and its market cap is really cheap at $3.6 billion, which means it has more growth potential compared to SoFi Technologies, which has a market cap of around $14.6 billion, and Upstart, ticker symbol UPST, which has a market cap of around $17.1 billion. On top of that, their addressable market is over $1 trillion. But what do you think? Comment your thoughts down below, like this video right now, subscribe if you are new, and I will see you in the next YT video.